Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of all the confusing corporate jargon so you don't have to. Today we're diving into a report that's all about staying on the stock market's good side, and it seems our company might be having a bit of trouble with that. We're looking at a Form 8K filing from Envoy Medical Incorporated. Now, an 8K is basically a report that companies have to file when something really important happens, something that shareholders need to know about right away. This one is a doozy, focusing on whether the company is still allowed to have its stock traded on a major exchange. Think of it like this: the stock market, specifically the Nasdaq in this case, has rules about which companies get to have their shares bought and sold. One of those rules is that a company's stock needs to be worth a certain amount. If it falls below that amount for too long, the stock market can decide to kick the company off, and that's exactly what this report is about. This report is dated August 26th, 2025, and it's talking about a problem that started earlier in the year. Back in February, Envoy Medical got a letter from Nasdaq saying they weren't meeting a requirement. Specifically, they didn't have enough of a market value. Market value in simple terms is just the total worth of all the company shares combined. Nasdaq told them you have 180 days, which is about 6 months, to fix this problem and get your company's market value back up to at least $35 million. That's a pretty significant amount, and it's important for a company to keep its stock trading on a major exchange like Nasdaq. Being on Nasdaq means it's easier for big investors to buy and sell shares, and it generally gives a company more credibility. Envoy Medical has two main things traded on Nasdaq: their Class A common stock, which is just the regular ownership shares of the company, and then they have these things called redeemable warrants. Think of warrants like a ticket that gives you the right to buy a company's stock at a set price later on. In this case, you could buy a share of Envoy Medical's stock for $11.50. These are often given out as part of other deals, like when a company is trying to raise money. Now, the big news in this report is that by the end of that 180-day period, on August 26th, Envoy Medical had failed to bring its market value back up to that $35 million minimum. Nasdaq sent another letter saying you didn't meet the requirement. This is a critical moment for any public company. If they don't get this sorted, their stock could be delisted, meaning it stops being traded on Nasdaq. This can make it much harder for investors to trade their shares and can really hurt the company's reputation and ability to raise more money in the future. But here's where it gets interesting. The company didn't just throw in the towel. They immediately jumped in and requested a hearing. They have a shot to go before a special panel, sort of like a review board at Nasdaq, and explain their situation. They have to do this by September 2nd, which they did. Brent Lucas, who is the Chief Executive Officer, signed off on this report showing the seriousness of the situation. The filing itself states that the company is optimistic about its chances. They believe they can show the panel how they plan to fix the problem. One key thing they mention is the recent resetting of its balance sheet with the full extinguishment of its debt. This is a really positive sign. It means they've paid off all their outstanding loans. When a company gets rid of its debt, it frees up a lot of cash flow and makes the company look much more financially stable and attractive. It's like finally paying off your mortgage. It makes your overall financial picture much healthier. They're hoping that this, along with other plans they have to boost their market value, will convince the panel to give them more time to get compliant. They are very clear though that there's no guarantee they might not get the extension. This whole situation highlights a major challenge for smaller companies or companies that are going through a rough patch. Meeting these minimum listing requirements is a constant pressure. It means the company not only has to worry about its core business, but also about the day-to-day fluctuations of its stock price to stay in Nasdaq's good graces. The fact that they are fighting this and have a plan, including paying off debt, shows a level of proactivity. If they can successfully plead their case and get an extension, it gives them breathing room to execute their strategy and hopefully bring their market value back up organically. However, as the report itself warns, there can be no assurance that the panel will grant the company's request. This is a significant risk. From a business perspective, it's crucial for Envoy Medical to demonstrate a clear path to profitability and growth. Investors and Nasdaq will be looking closely at their ability to generate revenue and manage their expenses. Paying off debt is a great step, but it's only one piece of the puzzle. They also need to show that their core business is strong and has a bright future. The report also includes a section on forward-looking statements. This is standard legal language where the company states what they believe will happen in the future, but they caution that these are just predictions and not guaranteed facts. They mention things like their ability to cure deficiencies and regain compliance. It's important to read these with a healthy dose of skepticism, as they are meant to protect the company from lawsuits if their predictions don't come true. Now, looking at this situation for Envoy Medical, it's a classic case of a company fighting for its place in the public markets. Their biggest strength right now, based on this filing, is their decisive action to pay off debt. That shows financial discipline and a commitment from management to improve the company's health. This can be very attractive to investors looking for companies that are serious about turning things around. However, the major weakness is clearly their inability to meet the minimum market value requirement for Nasdaq. This indicates that the market, for whatever reason, currently values the company below the threshold set by Nasdaq. This could be due to disappointing sales, concerns about future growth, or even broader market sentiment affecting companies in their industry. The risk here is clear: delisting. If they are delisted from Nasdaq, it could severely limit their access to capital and make their stock much less liquid, meaning harder to buy and sell. An opportunity for Envoy Medical lies in the hearing itself. If they can convince the panel, they get more time to prove themselves. They need to present a compelling story of recovery and future potential. They've got the CEO actively involved in signing off, which suggests leadership is squarely behind addressing this issue. In conclusion, Envoy Medical is in a precarious position, facing the real threat of being kicked off the Nasdaq. Their recent debt extinguishment is a very positive step, demonstrating a commitment to financial health. However, their ability to convince Nasdaq's hearing panel to grant them an extension and ultimately regain compliance with the market value rules will be the deciding factor in their listing status. It's a high-stakes moment, and we'll be watching to see if they can pull it off. What's your take on Envoy Medical's situation? Do you think they have a good chance of staying on Nasdaq? Let us know your thoughts in the comments below. If you found this breakdown helpful, give us a thumbs up and subscribe for more corporate insights. Also, make sure to join our Discord community, linked in the description, for more in-depth discussions. Thanks for watching, and we'll see you in the next one.